just to introduce Lee Kleinman. He will talk about a few things he wants to share with us today. Let me just admit a couple of more people. So that's our bi-weekly session that we get together virtually still with the commercial people of Southern California, KW Commercial. Lee Kleinman is the Senior VP of BFC Funding. And we had the pleasure to, I think last we had you, Lee, was maybe October of last year, so not that long ago. And thank you for supporting the team in various ways. So give us a bit, kind of background about you, whoever, don't know you yet, and then just take it from there.
Sure. Well, thank you again for the invitation. It's always great to be a part of such a great group, and I enjoy the time spent with you guys, whether it's in person or on Zoom. So thanks again for the invitation. My name is Lee Kleinman. I provide commercial real estate financing for owner users through the SBA 504 program. I started my banking and lending career, 33 years ago as a teller at Wells Fargo, and I enjoyed a 31-year career at Wells Fargo Bank after that teller position. I spent 10 years working in retail banking, and then after retail banking, I went to business banking, where I primarily financed commercial real estate through the SBA 504, SBA 7A, conventional, and investor programs. After leaving Wells Fargo, when they disbanded their local business banking footprint, I joined Business Finance Capital CDC. So I've been in my current capacity for 2.5 years, and I couldn't be happier because I get to finance CRE like I did at Wells Fargo, only now I get to do it in a far more liberal lending environment. So instead of getting maybe 55% of my deals done like I did at the bank, I'm probably at 95% right now because, again, I'm in a far more liberal lending environment, which is very enjoyable to get more people financed and help small businesses grow and prosper. Do I have screen share capability, Many? Looks like I do. Okay, so SBA 504, the structure is as follows. A bank will provide 50% of the purchase price in the form of a first mortgage lien on the property. And then I come in with an SBA 40% second mortgage lien on the property. Now, excuse me, there are a few situations where this 50-40-10 structure will vary. If a client is buying a special purpose or single use type property, then the structure will change to 50-35-15, because on a special purpose property transaction, like a gas station, the client has to come up with an extra 5%. If there's a business purchase involved where the real estate buyer is now going to be a new business owner, that would warrant an extra 5% down as well. If you have that scenario and a special purpose property, then you're going to be at a 50-30-20 structure. An extra 5% down for the startup, an extra or acquiring a new business and being a new business owner under 2 years, that would warrant an extra 5% down. And if the client's buying a special purpose property, that would be another 5% down. The interest rates are still low, even though they've been rising. The second mortgage rates and fees and terms and conditions are the same for every single borrower that qualifies for the program. Whether it's the strongest borrower or the weakest borrower, everybody gets the same terms and conditions on this second mortgage portion. Where the pricing varies greatly is on the first mortgage portion. So there's what's called risk-based pricing. Strong borrowers are going to get the best rates and fees, as I've quoted here. Weaker borrowers are going to get higher rates and fees because there's more risk within their financial profile. So this is for a B+ or better type borrower, or maybe A-. You can see that the bank that I chose to get a rate from is offering a 25-year fixed to match the second mortgage 25-year fixed, and they're at 3.87% as of today. If this buyer for this $4 million project, hypothetical loan scenario here, was considered to be a weak borrower because they have fluctuating revenue and profitability trends, they have weak debt service coverage ratios, they might have some lien and derogatory credit information in their public record or personal credit report, this could go from 3.87 for 25-year fixed all the way up to 6% for a 5-year fixed. So you can see that it varies greatly. One of my strongest value adds in being a CDC second mortgage lender is that I help the client pick the best first mortgage lender based on their financial profile, because I have relationships with at least 20 different first mortgage lenders. So instead of the client going to 5 banks and getting declined and getting discouraged, I can steer them in the right direction very early in the process, because I can look at a cash flow ratio and I can say, no, that's not going to fit the Chase or the Unions. We're going to have to go to a lower tier bank that will take on this type of ratio. So banks decline SBA eligible transactions every day because it doesn't fit that particular bank's credit policy. And you and your client might get discouraged and think that it's a non-doable transaction. But someone like myself, if I'm involved early in the process, I can guide your client to the right first mortgage lender very early in the process, saving them hours of time working with various lenders trying to get their loan approved. But more importantly, preventing buyers from getting discouraged and maybe canceling out of a transaction or of a desire to buy, period. When we prepare these, they're obviously rate estimates. So this rate is as of today from a top tier bank, but we all know that rates change daily. The SBA second mortgage rate, that changes once per month around the 10th of the month. So this is the March 22 rate of 3.92. This rate was over a half point lower 2 months ago. So obviously rates are rising, but they're still attractive in my opinion. Any questions on this loan scenario or the structure of the SBA 504 program before I go to the next slide?
You guys can feel free to unmute yourself or type on the chat. Lee, is there a minimum acquisition amount or loan amount for this program to kick in for the SBA? Sure,
I think there is a published minimum amount for the second mortgage loan amount. It might be $200,000 or $300,000. I've done $550,000 office condo purchases before last year. Probably won't find too much of an acquisition price lower than that in Southern California. So for all intents and purposes, for what we see and do every day, I would say no.
And is that always consist the SBA 40% of the loan?
Well, this is where we start 50, 40, 10, but there's a couple situations where the client might have to come up with an extra down payment. And like the example I gave a few minutes ago was if the client's buying a special purpose property, like a gas station, it'll change to a 50, 35, 15 structure. So there's a couple situations where the structure would change. But for most standard let me back up a third time. Most transactions, a client's buying a general purpose property and they've owned the business for 2 years or more. Most of our clients that we see meet that criteria. So they'll get the 50, 40, 10 structure. But again, there's a couple situations where the client might have to come up with a larger down payment, but it doesn't happen too often.
Hey, Lee, I got a question. This is David.
Hi, David.
Hi. These are for initial purchases, not for refis or anything like that. Or is there any program for refis?
There is. This is a purchase scenario. If this was a refinance, it would be 50% bank and 50% SBA. On a refi, there's no borrower injection required. The equity in the property is considered the borrower injection. So we're not higher than 90% LTV. We base that extra 10% on the equity in the property. So
based on the appraised value, or?
that's correct. Correct. So,
and what if a scenario that somebody has paid off property and wants to cash out? How does that work?
It doesn't work too well, because in order to do, there's one scenario where we could do a refi with cash out on a free and clear property. And that's only if the client wants to take cash out to perform tenant improvements on the property. If the client wants to refi a cash out property with my SBA 504 program, there has to be an eligible debt on the property to start a refi with no tenant improvements. So a free and clear property and the client does not want to perform TIs, then it's not SBA eligible. If the client has a free and clear property and they just want to perform tenant improvements, that's eligible. If the client has a property that has a loan on it, they can refinance the loan and take cash out. And those are the refi options that we have with the 504 program.
Thank you.
You're welcome. And on the refi topic right now, effective July 29th of last year, as a result of legislation signed December of 2020, we can now use the SBA programs to refinance existing SBA loans. Historically, that was never allowed. So right now, I'm using my 504 program to refi existing 504 loans and existing SBA 7A loans. So it's kind of a big deal, because in the history of the program, which is, I don't know, 40, 50, 60 years, that was never allowed, but that is now allowed.
Lee, if
sure.
I may ask, and that's just the curiosity of like behind of the metrics, like what, always question and ask why. Why do you think now they're allowing this to happen? What triggered that?
Sure. So it all had to do with the pandemic and all those relief programs and enhanced legislation that got signed into law in 2020 and 2021. So when former President Trump signed some legislation end of December of 2020, there was enhancements to the CARES Act that allowed for round 2 of the CARES Act, which gave waived payments and reduced fees on the SBA loans. Remember those days? Also built into that legislation was enhancements to the existing 504 credit policy. So they wanted the refi program to be more accommodating to business owners that might be suffering. And because the banks were the only ones to do the refis, the banks are more conservative. The bank's loan to value ratios are lower. So to help the small business community that's been suffering because of the COVID shutdowns and what have you, they created these enhancements to the refi program to make them more accommodating, more robust, more competitive. So clients have access to capital with more liberal underwriting criteria and higher loan to value ratios compared to the banks that were doing the refis before these new SBA rules. Hope that helps. Any other questions on the refi programs? All right. So just like a bank, we have a credit policy manual, and it's called the SBA SOP. SOP stands for Standard Operating Procedure, also known as a credit policy manual, as it was called when I was at Wells Fargo. So there's 3 SBA SOP policies that I think are value added. And in all fairness and honesty and transparency, I didn't even know these existed until I joined the CDC 2.5 years ago. So every day is a learning experience. The first one has to do with an appraisal shortfall. There can be up to a 5% appraisal shortfall, and the government does not require any additional injection, which is very good news. And this only comes into play if the seller is not willing to reduce the price and the buyer still wants to overpay for the property. And in today's market, I could see that happening where a seller's going to hold firm because it's a seller's market, and the buyer's going to still want to buy the property because it's hard to find inventory these days. So for example, if a client's buying a building for $1 million and it only appraises at $950,000, which is a 5% shortfall, we can still finance $900,000 against the $950,000 appraisal. So it's basically a 95% loan to value instead of 90. So this is an SBA policy, but not every bank follows our policy. So I had a bank refer me a transaction where there was, I think, a 7 or 8% shortfall, and we were going to cover the first 5 with no additional injection, and the borrower only had to come up with an extra 2 or 3% to make the deal work. But the bank that referred it to me would not follow our path with this policy because they didn't want to overfinance the actual appraised value. So with the clients insisting, I had to find another first mortgage lender that followed suit with the SBA allowed appraisal shortfall policy. So it's just one of those nuances where just because it's something that's good for the SBA doesn't mean that every bank is going to follow. But because I have relationships with like 20 different first mortgage lenders, I was able to find a new home for that transaction, and it closed just a couple of weeks late. Any questions on that topic? Okay, the second one here has to do with if a client is buying a building. Let's say it's a doctor buying a building and they need to buy some small pieces of equipment, office furniture, some computers, and maybe it's a big project and they want to preserve cash flow and have the cheapest payment possible. If you look at the bottom section here that says furniture and fixtures, we can actually roll in the cost of those small pieces of equipment into the real estate project without having a higher value on the appraisal. So we're actually able to overfinance like the first topic that we were talking about without having a higher value. So we can roll in small pieces of equipment. There has to be a small weighted average compared to the overall size of the project. If you're buying a building for $1 million, you can't roll in 700,000 of equipment because that's just too much. And there's a chart that my team uses to figure out what's the right amount. But I've done $2-3 million deals where the client wanted to roll in $300,000 of small pieces of furniture and fixtures, and that was no problem. And not everybody wants to finance equipment over a 20-year real estate loan, but some people do because they want to have the lowest payment possible going into a new real estate project. If they were to take that same $300,000 and get a regular 3 to 5 year bank equipment loan, the payment would probably be 10 times what it would be rolling it into our commercial real estate loan, or 5 times the amount. So it's just an option there that not everybody wants to do or take advantage of, but it's nice to have when people do want to take advantage of something like that. The next one to me is the biggest value add. You can buy a building that has a structure on it and still meet the 51% or greater owner occupancy ratio and requirement without occupying 1 square foot of the structure. You might be saying, how is that possible? Well, here's how that works. For businesses or industries that require lot or land space, let's take a plumbing contractor, for example. They have trucks, equipment, machinery, piping that needs to be stored outside. Well, that use of that excess lot and land space is eligible to count towards the 51% owner occupied requirement. So I actually did a transaction last year for a plumbing contractor that bought a lot that had a small structure. That small structure was leased out to a third-party tenant for years. So he had no way to occupy any of that structure square footage for years. But net of their parking space, the excess lot space, I'm just going to pick random numbers, I think was like 5,000 square feet, and the structure was 3,000 square feet. Because the plumbing contractor was going to occupy that 5,000 square feet of excess lot and land space, that is more than 51% of the excess lot and land space and the structure when you add those two together. So that's good to know for the industries that we work with. They actually have some examples here. See what they say. Outdoor storage yards, general contractors, trucking companies, moving and storage companies, boat slips, and docks for marinas. So this is just a small example of the types of industries that could benefit from this rule. I'm just curious, did anybody know about this before? Oh, they're on mute.
No.
No worries. I just learned it about a year and a half ago myself. I wish I knew it earlier when I was funding loans at Wells Fargo. I probably lost a deal or two not knowing about this. But I think it can come in handy depending on the industry type and the situation with the structure. Any questions on any of these three, what I call favorable credit policy entries? Nope, okay. So this is what I call an SBA 504 informational sheet. Has a lot of great information about the program. The maximum second mortgage dollar amount is $5 million per property for non-manufacturers. Manufacturers get $5.5 million. So again, this is the maximum per property. And it doesn't matter if you burn through these limits with one large property or 10 small properties, because there's no limit to how many SBA loans that you can have, but there is limitations based on the lending limits. Excuse me. So once a business burns through these limits, which is easy to do in one deal or or two or three deals, and they need to buy more properties for their business because they have multiple locations, we can use the Green Initiative program. And that's down here. Once you burn through these limits, you get two more $5.5 million borrowing tranches. So a client could have up to $16.5 million in just second mortgage debt alone, which means they could own, I think it's about $50 million worth of buildings through the SBA 504 program. I've been financing, whether I'm doing the first mortgage at Wells or the second mortgage here, I've been financing commercial real estate for 23 years, and I haven't seen a small business owner need that much borrowing power. So it's nice to know that it's there. And the way we go green is the environmental vendors like 𝐑𝐞𝐚𝐿 and Fulcrum, they have an energy analysis department. So we hire them for that third report that's needed to analyze the energy consumption at the new building. And there has to be a 10 or 15% savings on the energy bills. And that's normally done by installing solar panels. And the vendor who does that report will actually go out and get a solar panel bid included in the report. And those solar panels can be financed into the project. And the green program gets you more borrowing power. You know, we do it all the time, and it comes in handy very, very often. Let's see what else is worth mentioning here. How funds may be used: acquisition of an existing building, refinance of an existing debt on an owner-occupied building. We do tenant improvement financing, remodeling financing, whatever you want to refer to it. In fact, I would say that about 65% of my transactions include some form of TI, ground up, or construction-based financing. So it's a big part of our business. And so if a client's buying an office building and they want to remodel it or what have you, all they need to do is give us the bid and any applicable floor plan drawings early in the process. We'll give that to the appraiser. The appraiser will come back with an as-is value and an as-completed value, and then we'll close the escrow with the as-completed value. And then after the close of escrow, the bank first mortgage lender will make disbursements to the contractors. So financing, construction, tenant improvements, ground up, that's all part of the SBA 504 program, and those options are commonly used by our clientele. I talked about the fact of rolling in small pieces of equipment into a 504 project. That's for small pieces of equipment, furniture, computers. If a client wants to finance large pieces of equipment, heavy fixed assets like vehicles, printing presses, CNC machines, the 504 program actually has its own equipment loan separate from real estate financing. That's a 10-year fully amortized equipment loan. So if a manufacturer is buying a building, they can buy their building, and you can't roll in this heavier type of equipment into the project. So that's why they have that separate equipment loan for 10 years for the heavy machinery and fixed assets. So many times we have a manufacturer that's buying a building. They'll put 10% down, 50, 40, 10 structure on the building. And they also want to buy more equipment because they're buying a bigger building and they need more equipment. At the same time, we will give them a 10-year SBA 504 equipment loan. And that rate and payment is going to be lower than going to the bank because most banks only do a 5 or 7 year equipment loan on heavy machinery. So it gives the client an opportunity to have a lower rate and a lower payment because we're going to amortize that equipment over 10 years. I talked about land and new construction. We just approved a transaction in Camarillo for the 7th location of a restaurant chain that's complete ground up construction. So we definitely do those as well. Some of the first mortgage banks are kind of picky with financing a restaurant during the end of a pandemic, but the client's existing bank was able to come through and provide the first mortgage financing for them. Obviously, the intent of the program through the Small Business Administration is to create jobs, expand the economy, assist with US manufacturers, buying bigger plants, what have you. So that's why we're called CDCs. You know, I work for what's called Business Finance Capital CDC. And a CDC stands for Certified Development Corporation. That's what the government labels us. And there's 210 of us nationally, and we're nonprofits. And all we do is facilitate the second mortgage portion of the 504 program. So we're basically the intermediary between the customer and the federal government. So my team is, you know, we're not government employees, but we're licensed by the government to do what we do. And this is all that we do, is the second mortgage portion of the 504 program. I talked about an extra 5% down for startups, or if the client's a new owner of a business. And then if that particular client is also buying a special purpose property, that would make it a 20% down deal. So this just kind of highlights what we talked about earlier. And I'm proud to say I work for a successful hardworking, winning team. The government fiscal year end is September 30th. And for the year end, September 30th of 2021, my firm finished #1 in LA County based on the SBA ranking of loan units. And typically when you have more loan units, you have more dollars lent as well. So there's only 30 or 40 of us, but we're smart, intelligent, very knowledgeable with the SBA SOP. We know how to get deals done through the SBA Loan Center in Sacramento. And I'm happy I chose the company that I'm at 2.5 years ago, so I can add this knowledge and skill set to my clientele and people like yourselves. Another talking point that I think I'll share before I open it up to questions. Last September, the 504 lending limit ran out of money. And that was the first time that happened in the history of the program. And I attribute that to very low rock bottom interest rates. And many people were applying to get the CARES Act payment waivers and fee reductions. So last September, I think it was around the first week, let's just say last September 7th, the 504 program ran out of money. So we could not get approvals on loans for 3 weeks, which wasn't too bad. As of a month ago, the current fiscal budget for the 504 program, based on activity from October 1st until now, it was projected to run out of money June of this year, which would have been 3 or 4 months with no SBA loan approvals, which would have been horrible for customers and everybody in the CRE industry. But recent legislation through funding bills that the president just signed increased the 504 lending limit. So we have enough money to last us through September 30th, based on current production levels. So I'm happy we don't have to deal with that dry spell of funds in the summer. So that's pretty much the talking points that I wanted to cover today. And obviously I'm here for as long as needed to be to answer any questions.
Lee, do you mind just putting up the previous slide with that one-page flyer, which I think it's really awesome. Yeah, really cool flyer. And of course, if you can share this with me afterwards, I will email.
Sure.
It's kind of summarize the whole thing. I mean, it sounds like a really very solid plan overall. It's pretty legit. Interesting.
Yeah, I mean, you know, obviously the buyers have options. They have the 504 program that I do. They have the 7A program. They have the conventional program. I think this is the more popular and more desirable program out of those three, because the 7A has higher rates and fees. And on a 7A, if you just put 10% down, you have to pledge 5% of additional collateral. So now in the 7A's fairness, when I cannot get a client approved through a 504, whether we don't like it or the bank doesn't like it on the first mortgage piece, there are some very aggressive 7A lenders out there that will do more weaker, higher risk deals than I can get done through a 504. So that's another value add that I offer, is that when I get a loan file presented to me, and if I cannot get it done as a 504, more often than not, I'll be able to find an SBA 7A lender that will step up and save the day. And then when you go to a conventional lender, the down payments are usually 20 or 25%. And either the client doesn't have that, or they don't want to part with that much. So I feel comfortable recommending the 504 over and above those two other programs for those reasons.
Any questions for Lee of any kind?
Does 504 apply to multifamily?
excuse me, it does not, because the spirit of the program through the Small Business Administration is to help small businesses grow and prosper. So these are limited to 51% or greater owner-user transactions.
So more like single retail scenarios.
It could be, well, I have financed office buildings before. I have financed retail centers before. But as long as the client's going to take up enough units and space to be at 51, then it could be really any type of commercial property. It doesn't have to, could be multi-unit, could be multi-story. I've done 7-story office buildings before where a law firm was taking over, 3 or 4 floors.
Mhm.
So
I just figured multi-family, like I'm a small business, so I'm trying to grow the number of units.
you're in someone's definition book, you're not a small business, you're an investor.
Hey, Michael, how many cousins do you have that can take units in that complex?
That was going to be my next question. We got an extended family,
No, but I've done all types of properties, self-storage, car wash, retail, industrial, office, mixed use. I've done deals where there's housing units either on the second floor or in the back. And as long as the combined square footage of the residential units and the commercial space, as long as the commercial space is 51% or more, we can do commercial and residential mixed use properties. I've done dozens of those over the years.
Mike, what's interesting? Someone like yourself, you're the people that you're in relationship with, professional, but also you take it more of the kind of personal relationship, etc. And you probably know, maybe you don't, to some, but most people think about, okay, you have your investor or owner of the property, etc., and they own a hotel, or maybe they have a few multifamily, small size, big size. Do you guys really know what other businesses or other properties do they own? I mean, maybe you do, maybe you don't. So it's interesting, huh?
Yeah, you have no way to know exactly what else they have in their portfolio.
So just by doing those, having those conversations, doing those touches, even to explain like what's out there, that could lead to different opportunities, even if you don't specialize in that per se. Even though, okay, so Michael 𝐸𝐚𝐻𝐡 is the hot stuff in the apartment building, big capacity nationwide. But do you mind selling a few gas station here and there, whatever, or refer to someone just because people know that you can transact it or you have access to those kind of
there's been many scenarios where I had no idea who to turn to for SBA scenarios. I'm going to hit you with a very curious one, Lee, just out of my own curiosity here. What about the cultivation industry? Is SBA, nothing to do with the cultivate. I was curious to know because they're technically occupying space.
They are, but we don't have to lend to every industry.
That's true.
Good question.
No, there are some restricted industries. Cannabis is one. We don't finance developers. There's not a whole lot of restricted industries, but there are some. There are some. Yeah.
Coco has a question. Is there a limit to the location, county, state that you're able to close in?
So the program is nationally. Every state has a CDC, like my company. I have closed transactions in Arizona, Nevada, Texas. What I tell people is it's a slam dunk for California, Arizona, Nevada. If it's out of those 3 states, then it's case by case. We can partner with a CDC. I think the deal I did in Texas, we did the underwriting, we did the credit memo, then we gave the file to that Texas-based CDC, and they did the submission to the SBA Loan Center. So I would just say run it by me, and there's a good chance that we can help you with that.
And then another question from Albert. I'm just running, reading on the chat. What is this program work for a brand new business, or it has to be established business?
Both scenarios are eligible. So it does not have to be someone that has owned the business for a long time. So I'm involved in a gas station acquisition right now. They're buying the business and the property as an owner user. And that's going to require 20% down, because it's 5% because they haven't owned the business that they're buying for 2 years. They haven't been the business owner for 2 years or more. So that's an automatic 5% down payment, which talks about right here that I highlighted on the flyer. And then it's another 5% down because it's a special purpose property. So that's a 20% down deal. And the program does do startups as well. Like, I've done a lot of deals where the client's buying the business and the building. Those are a lot easier than just a complete startup, for obvious reasons. That business, we collect the financials. That business that they're buying, we collect the financials. We can see that the business supports the debt or not. On a startup, you have no idea what's going to happen day 1 or day 1,000. So we're usually on board with the startups, but the problem is finding the first mortgage lender. Many of the first mortgage lenders that do the 50% portion over here, they don't want to participate in this program with a startup. I'm not saying it's impossible, it's just more difficult. They're going to probably want more down payment, additional collateral on another piece of property. Or if I can't get it done through a 504 program, then I can go to some of the very aggressive 7A, SBA 7A lenders. So I hope that helps and answers the question. If there's any follow-ups on that topic, please do let me know or ask me right now.
And I did share in the chat as well, Lee's info, number, email, etc. You can reach out and have more conversations or whatever resources you need. But Lee, again, if you can,
I'm going to email these 4 slides to you and Kim when I end this call.
Yeah, so I'm going to do that as well for sure. So you guys are going to have that marketing piece, so just for your own resources. Good stuff, Lee.
Many of you have relationships. Oh, just 2 more minutes, okay?
Yeah.
Many of you have relationships with bank first mortgage lenders. And I'm never going to say don't utilize those existing relationships. But if you have a client that is interested in a 504 program, it behooves you and the client to get someone like myself in early, because you could go to a bank and it might not fit that bank's credit policy underwriting criteria. The bank might not like that particular piece of collateral. So there's a million reasons why that bank can turn down an SBA eligible transaction. And that happens every second of every business hour of every day, of every month, of every year. I just encourage, if you go to a bank and they say, we're on board, we're fine, and they'll bring in a CDC, all the power to you. But if you think there's any hair to the transaction or this or that, or you hear about a client getting declined at their bank, you definitely want to bring in someone like myself who can help navigate the SBA more thoroughly and with more success. So I'll leave it at that. And again, I really appreciate everyone's time and partnership.
Awesome presentation, Lee. Thank you for the info. Other questions, anybody? For Lee? Okay, and again, I'm gonna send that data. We're gonna get it later today. Lee, thanks as always. Welcome to stay. Anybody wanna pitch any kind of listing you have, any need whatsoever? Now is the time.
I just want to share that I got a new bottle of Don Julio 1942. So I thought I'd just share.
And that's
Don't
going
tell
to
Lee.
be
He's
used
gonna
for,
drink half of it himself.
for its celebration.
Nah, it's all gravy, baby. It's all gravy. Now that I got my Don Julio, it's all gravy.
I think Michael's already finished half the bottle already.
Well, do you want the full bottle or the non-full bottle? Because we have both of those. We have that one, and then we got that one. So it's really, you know, you tell me which one you want to, you know, A, B answer here.
Welcome to the commercial world.
Love it.
Hey, we get down straight to business here.
I love it.
As long as we get it done, that's all that matters.
That's right.
Exactly.
Amit, do you have the list to pitch?
Nah, nothing new really. Everything we have right now is basically under contract.
Wow.
The only one right now that I can talk to you guys about is 7625 Eastern in Bell Gardens, L-shaped shopping center, 7-Eleven anchored, multi-tenant, currently being offered now at just under a 5 cap at $5,395,000. There is probably a little bit more flex in that price as well. If you want more information, send me a quick email. I can get you a new updated marketing package on that one.
You should send a copy of that over to Danny Hurst.
I'll get it over to them.
You know who
Is
I'm
he
talking
exchange?
about?
Is there an exchange right now?
Danny Hurst that works out of the Santa Monica KW commercial
No,
office.
Is he exchange right now himself, or has he got a client?
He's always got clients. He's
Yeah.
always got clients. He just closed that big $30 million deal down in Hollywood.
I've known Danny since he was in elementary school.
I went to elementary with him.
You went to VBS with him?
Went to Kadima with him.
You went to Kadima with him, okay. You went to Kadima after VBS, there you go.
And
I was in the same grade as his sister Raquel.
oh, okay. So we all went to
Did
TAF
you
together.
Omi, did you put the bakery in escrow?
The bakery, he is not a seller, let's put it that way. He's in a way cooked the books to the point where nobody can get a loan, SBA loan or anything else, because he's showing a loss for the last X amount of years, even though it's not really a loss. So whoever's trying to get a loan on it just can't get it, and they don't want to carry themselves as owner financing or seller financing. So
Off to the next one.
what can I do?
I'm going to say goodbye. Thanks again, everybody. Take care.
Lee, thank you so much for
Thank you.
Thank you. Take care.
for